Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey and Shad here, your hosts for this weekend's edition. We're going to start off in the first half of the show discussing market moves, the opportunities that investors could have within some of the sectors that continue to perform quite well, a number of opportunities in the markets, as well as touch on rates, which continue to fall in the US dollar, looking at that 100 level on the dollar index. In the back half of the show, we're going to switch to the energy sector again, which unfortunately has been a little boring, but there still could be some opportunities there as the oil price has generally faded, but still is very much within a range. We are kicking off the show with Rick Bensignor, president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. And on the retail and individual side, you can check out the In the Know Trader website. I will post a link in the show notes to that site, which Rick has 3 products. A monthly report called the 7-Eleven, where he picks no more than 7 of the 11 Spider ETFs with the goal to beat the S&P, a weekly report called the Tactical Trader Report, and a daily report called the Daily Tips Sheet. Rick, let's start off with, broadly, the last time we chatted was mid to late July. That was before the yen carry trade sell-off day and even the couple days of weakness before that, which had a lot of investors, I think, a lot more fearful of a larger market correction. Turned out that after that Monday on that yen carry trade sell-off, boy, oh boy, that was a definite buy-the-dip opportunity because look at how much these markets have ripped back. Rick, give us a little recap of how you traded around that time and your thoughts on the stability of this market after that pretty quick drop, but then rebound.
So, Corey, I did nothing that day. Actually, didn't buy or sell. But what I was waiting to see was whether, how much the damage was and what was the reaction. And by 3 days afterwards, I was already in print telling my clients no technical damage was done based upon the models I look at. And as the bulk of the models I look at are not what most people look at. And because of that, as compared to virtually anyone who's, let's say, technically oriented, who's been interviewed on business television and radio networks since then, who were all selling into the rally, 3 days after August 5th, I told my clients, no technical damage done by the market. And the best way, and what I did as kind of a hedged trade, just because if you got another round of the unwind of the carry, the market could come off again. What we did was my recommendation was go long the MAGS ETF, that's the MAG7 MAGS, and short the RSP, the S&P equal weight, the S&P 500 equal weight ETF against it. And we just finished taking that off yesterday. And it doesn't mean it can't go higher, but what we did is we made, I think, about 430, like 4.3% in a hedged trade by essentially buying the top end of the risk market, but having it hedged. Because when you get events like that, to simply have bought without having some hedge certainly would have done better, but in 40 years in this business, to me, the smart way to play something like that is to have a hedge trade that goes, if the idea is right, you're going to make money. You'll give up some upside to be protected in case you got another headline like you did. And all of a sudden the market's, down again, huge amounts. The net after effect is that yesterday, well, let's go back to today's Friday. So Wednesday, marked a DeMark setup 9 count that filled the last upside gap, made one day after the market made its all-time high. Then yesterday marked a sequential upside exhaustion signal, also a DeMark indicator. Those two combined showing up a day apart. No surprise that yesterday went from an up day to a decent down day. You've got institutional traders who sold into the rally at that point to lock some profits, and I think smartly so, going into Powell's comments earlier today. You never know what the Fed chairman is going to say. You never know if something comes out of left field. Not a bad idea to take some money off the table. So despite the fact that the market was up decently this morning, is now barely up 0.5%. And people are settling into the fact that we could be still again close to a near-term top. And I'm generally in favor of buying the dips because the same time that I came back and said that no technical damage was done, I also reiterated the long-term upside target for the S&P, which is just north of 6,100. And I do think we get there in this general bull cycle. That doesn't mean we can't sell off on some news. It doesn't mean in kind of what I would suggest would be a worst case scenario for some reason that right now I wouldn't know what the catalyst would be, but it doesn't mean in some crazy way we don't potentially have a trading range with now a double top near what was the previous all-time high, and much of what we saw into the August 5th low. It's very possible that you give back a heck of a lot of the rally. But in the bigger picture, I think nothing was done to damage the charts, and that we're still headed for just north of 6,100 in this bull market that started back in October of 2022 on a secular basis, and then got the cyclical low in October 23.
All right, Rick, so you still think there's some upside in the S&P up to that 6,100 level. It's interesting that when you did the pair trade, the hedge trade, that you shorted the equal weight index. What does that say about the market breadth for the rest of the S&P 493 versus the Magnificent Seven? Do you still expect the mega cap tech stocks to keep outperforming? Is there any catch-up trade potential in that move to 6,100 in some of the other areas of the market?
I don't mind kind of reducing that exposure because right in here, the same way that the S&P kind of went 9 days in a row and closed above its closing price from 4 days prior, which is a particular pattern, part of this DeMark model. The spread, the ratio of the Mag 7 names versus the equal weighted S&P did the same thing. And it's often a turning point. It doesn't have to be a major turning point, but for the near term, I'm very comfortable having taken this off, unwound the trade yesterday, and I'll watch to see now. If it starts heading back up higher in favor of Mag 7 names, then I may very well put it on again. But I think that for the time being, you want to still have exposure to Mag 7, but pay attention. And a lot of individual investors are not in the mindset of doing this, but I think you need to be looking at how the Mag 7 does against equal weighted S&P, standard S&P, to get a sense of when and if you start getting some type of upside exhaustion of the mega cap names, those 7 names versus the rest of the market. So because yesterday had a signal that it could be a near-term high and potentially even more than a near-term high, I think personally, it was a great trade to come back on the long side to get my clients long. There's only one short trade I put on since that drop, and I didn't put it on until the market had rallied decently. And when we ended up losing on that particular trade off of my daily tip sheet, which puts out 3 to 4 new ideas a week, we lost just, I think it was 2.2%. Something like that. So a very respectable loss versus some of the other names that, I mean, since August 5th, I think we're probably up over 20% in the trading account on the daily tip sheet, just having had 95% of all the trades be on the long side and catching some. We got long Dell at 99. It kicked the bulk of it out at 110. So there's 10% in a trade. I still have a quarter left of that. We went long silver miners. But, since just in the few weeks since August 5th low, I've been predominantly long and saw the reason to be a buyer versus most technical-oriented people who've been selling into the rally.
Oh man, people got scared from that fall, but hey, even today, to your point, the markets did open up on the day, but the VIX was also up over 15%. So, bit of a dichotomy there. Let's filter down to the rate environment, because the last time we chatted, again, about a month ago, you outlined critical support of the 10-year right around 4.13%. Well, clearly that's been broken because the 10-year is now down below 3.8%. This is all tying into more rate cut expectations. Rick, where do you see rates going from here?
So we had bought bonds this year at the two peaks, precisely on the days of the two peaks, 4.72% and 4.6%. And the cover, we actually got out on the morning of August 5th. In my weekend institutional report, which you guys get, I had said the trading bottom would be at 3.68. Well, what was low on August 5th? 3.67. By 1 basis point, we essentially covered one tick from the low. And with the bigger picture, still with a measurement down to 3.53%, as a potential longer term, or actually I'll call it at this point, I'll say it's a medium term target, all measured off of the 5% high. So 3.53 has been the big target off of the 5% high since we've made that. But from a more short to medium term basis, I told my clients 368 is the best you're going to get right now. It worked well. Rates are in the low 3.8s now. And I actually sent out a special report to one of my very large institutional clients that's a pure fixed income place, and told them yesterday that I think, barring Powell screwing up what the market is already built in, and he didn't do that today at all, I actually think rates could get up above the 4.02 high that they've made since that 3.67 low and get to like 405 to 409. Fill the gap there, and then you're going to start getting into the major resistance again that starts at 413 and goes all the way up to 4.28%. So I am much more in favor of tactically playing bonds now than strategically playing them. The bulk of the down move in yields has been met, and I think you're much better off for those who have the talent to trade that market as compared to simply positioning yourself for significantly lower rates, given that we've really seen, I think, a dramatic drop. When you think about 5%, the peak at 5% went to 3.79. So that's a 121 basis point move. From 379, we got as high as, I think it was 4.64. And that's when we bought again at 4.6. And so take away 121 basis points from 4.64, the same. So to have equal moves down measured from that 5% high, you get 3.53. So the fact that we got into the 3.6s, I'm not going to be a pig to try to get those last 15 basis points. And I had a reason to buy at 368, and obviously that was to cover at 368 and in yield terms. And I think it's the right thing. So in general, no, I don't think rates are materially moving higher, but from just the normal back and forth of how markets work and the general belief that rates are going lower, I think you've got enough people believing that. You now have a Fed chairman who all but said it today. Of course, he didn't quite say it, but he's like, we're ready now. The signals are lined up. We're just waiting for some further confirmation. So, the first week in September, you're going to get the unemployment report, and that'll be a big thing. But my guess is the market coming into today had a 75% chance, based on Fed fund futures, that the Fed was going to cut 25 bips in September, and a 25% chance that they would cut 50 bips. Now, I'm not in front of my screens now, so I don't know where that is. Let's put it this way. He didn't say anything to change my scenario to think that right now, tactically, yields probably move higher and take out that 4.02 high just to squeeze those who were playing against that level, and we push up towards that unfilled gap and maybe play with that 413 level again, which is where we broke down from.
All right, Rick. So like you said, tactically, you're looking for rates to maybe jump up a little bit, especially with everybody leaning towards rates going down. Maybe that catches some people off sides, but then eventually you do see it going back down again, the rates. I was going to ask you, with so much of the anticipation of the Fed rate hike already being priced in interest rates and them really doing the job of the Fed months ahead of time because the Fed still hasn't even done their first cut yet, do you see that maybe most of that is already priced in, providing we get this little jump up and maybe it goes back down? Most of the move is over now as far as rates going down, because we saw the bond market go on a 40-year rip from 1980 all the way to 2020, where interest rates got down to 0.4%. And now a lot of people believe we're in a structural situation where bonds and may keep selling off and where rates may keep going up for decades. How do you look at it from the longer time frame as far as the bond market?
I think that that 40 basis point secular low will be the low, will not be challenged, and that in the big picture, for those people who own bonds in their portfolios, ultimately you're probably going to want to sell those, because any sense of a return to equilibrium pricing, 50-year pricing, 80-year pricing, just long term means rates are going to go up. So could we stay down at something in the 3% range, even get into the upper twos? Sure. Do I think we're going to under 2.5%? I don't. And we could stay in this range for years, but I think we're done. That 40-year bull market is done. And it's just a matter of finding places in which, for those people who own bonds, ultimately you want to sell out of them. The 40-year bull market that you talk about provided incredible returns for investors from that 1980 to 2020 period, because the value of their bonds went up so much on top of whatever yield they were getting. Now, if you bought bonds in 1980 and you locked in 15% on a 10-year, it was phenomenal. If you bought bonds in 2020, you unfortunately made virtually nothing and got your rear end handed to you, because the price of the bond fell so much. Obviously, elderly people tend to own bonds as a decent part of their portfolio as compared to being aggressively being in stocks. If you're a 30 or 40-year-old, you shouldn't own bonds. You should own, and I tell my kids this all the time, go into the most aggressive growth. For your 401ks that your companies offer you, go into the most aggressive growth names and ETFs, whatever, mutual funds, whatever is offered. And I don't care what the market does, just max out your 401k contribution every year and just buy the most aggressive you can. Because if you're a 30-year-old and you're not going to touch this money for 40 years or more, there's nothing that's going to be growth in the stock market over time. Certainly bonds will not. And if you're in that age category, that's what you do. If you're a 60-year-old or a 70-year-old and you're kind of in the latter part of that phase of income in your life, and some are retired, sure, you generally want to own bonds for the guaranteed return. But if we get down towards 3%, let's say in a 10-year, I'm not going to tell you that you really want to be locking in 3% for 10 years, because the likelihood is that it's just a matter of time before rates ultimately start moving up in the bigger picture of return to equilibrium. Long-term treasury pricing on a 10-year is probably closer to 6, 7, 8% than it is to the current 3.6%, 3.8 where we are now. And if they go lower, I only see that as likely losing money over time, because the value of those bonds will decrease. So at that point, I would say if you're in that kind of typical age group where a financial advisor would typically say you want to be 30, 40% or more in bonds, I would say thank you very much, but no, I will be in very short-term instruments rather than locking in 10 years to make, let's say, theoretically 3 or 3.25. I think that's going to be a losing trade for you over time. That 3% that you get will not offset the value of the bonds that will likely decrease on you.
Interesting. What a different bond market and world we are living in. Let's move over to the US dollar because that's been moving down really ever since mid to late April, now closing in on that 100 level on the dollar index. Last time it was here was in December of last year and very briefly July of last year. But below 100, we really have to go back to early 2022 when the dollar was rising. Rick, how important is this 100 level on the dollar index? And do you think that the dollar is in a new trend that could just continue lower?
It certainly could, Corey, but here's the caveat. By and large, in this cycle that we're in, generally, the dollar has moved with rates. Not day after day. It doesn't have a correlation of 1.0, which means they completely move together. However, in general, rates and the dollar have been similar. Has something changed in the last few weeks? The only thing that's potentially changed, and I don't have enough information on this yet to believe it's actually happening, but there's some little chatter on the street that hedge funds, rather than being short the yen now, are switching to short the dollar and use the money that they by selling dollars to buy other instruments in higher yielding places. If that's true, that will be continued pressure on the dollar in general. In the near term, if I'm right that rates are going back over 4%, then I think those who are traders look to buy the dollar, even potentially today or Monday, and look for a quick pop in the dollar. So I don't see the dollar index going to 95 if the U.S. 10-year hangs around 4. If the U.S. 10-year gets to 3.25, that's a different story.
Well, Rick, what does that mean for gold then? Because gold tends to react to interest rates and the dollar. If there's kind of a dichotomy between rates and the dollar right now in the short term, what's your short-term outlook and maybe medium-term outlook on the yellow metal?
So I've owned gold for years, and I'm actually wrote clients within the last week or so that I think gold is getting close to a tradable top, enough so that it's going to be worth selling out of some of my gold. So I may very well in the next few weeks sell out of a third or more of gold that I've held for 10 years, or forget when I first started buying gold, but I have these are going to be capital gains, and some of it's in my retirement account, but some of it's not, and I got to figure out which one I want to sell from. But I do think we're probably closer to some near-term top in gold, which would also imply at some degree some type of bounce coming in the dollar. If the dollar's going down to 95, then gold is not close to its top. If the dollar is somewhat near bottom, I could make the case that gold could have, I would say, let me think, at the current price. So 10% is in the neighborhoods of $250, give or take. Yeah, I could see a potential 10% drop in gold. So that doesn't destroy the charts or anything, but 10%, it questions now the longer term picture of just how much higher gold will go in this cycle.
Hey, gold has been on an absolute tear along with some of the markets, but gold just keeps on breaking out to some all-time highs. But yeah, if interest rates, if the dollar start to move in the opposite direction, could put a little headwind into that rally. Rick, we're out of time here. Thank you very much for taking time with us on this weekend show. Always find it interesting to view how you're viewing the markets and how you are trading them. Again, Rick is the president of Bensignor Investment Strategies. I will post a link to the In the Know Trader website in our show notes. That's where you can find all of Rick's retail and individual investment products. Rick, thanks again for your time on this weekend show.
Thanks, guys, for having me. Always appreciate the time.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. As promised, we're shifting our focus again to the energy sector. I know a lot of our listeners keep responding to us that they do like this energy content that we are bringing on with a couple of our regular guests in the back half of this show. It's with Josef Schachter, founder and editor of the Schachter Energy Report, also editor of the Eye on Energy Report. That's a free offering from Josef that recaps more the fundamental data for the oil and natural gas markets. Also, to note, Josef's conference, the Catch the Energy Conference in Calgary, happening again in October this year, October 19th. Josef has sent us a special code for all of you, our listeners, to sign up for some free tickets and also to sign up for a subscription, whether quarterly or for the whole year, to the Schachter Report. I hope you do sign up for that, especially all of you who are focused and investing in the energy sector. Josef, let's start off with a broad overview on what's happening in the oil and natural gas sectors. First, oil. Look, oil has been fading in price. It's now in the low 70s, still very much range bound, but this recent downward action just over the last about week and a half has broken some of the at least short-term lower levels, but we can go the whole way back really to the beginning of the year when this is around the price that oil entered the year. Josef, what's going on here? What's pushing around this oil price? How much lower do you think it could go?
Well, the premium for oil, because of the concern about the war potential with Iran, we rallied at the end of July from 71.67 to 80.16. So, a big bump over $8 there on the war premium. And there was a war premium before that because, of course, Hamas and Hezbollah and everything else. We've come down from that 80.16. Today we're 71.60. And I still have, and I've been saying for months, and last time we talked, we were $77 or so, that we were going to break 70 and potentially go down to the 66 to 69 level per barrel. And that would probably give us a very strong and important bottom. And the stocks would correct another 5-10%, and we'd get some quite attractive bargains. And I still believe that is the case. And I think sometime in September, we'll be sending out action alert buys with some new additional buys plus reiterating buys on names that are currently on the list. And the reason for that is demand in the two biggest markets is weak. China, of course, there's been lots of reports about diesel demand falling sharply, imports of oil going down by China, lots of problems in the manufacturing area. Consumers aren't buying as much EVs or buying cars, and so there's the lack of demand mainly from diesel, but overall refineries are seeing lower demand. And then you've got the United States, where demand is down this week, 101,000 barrels from last week, and overall demand is flat with last year, but gasoline demand is down by 0.8% from a year ago. So the data is clearly coming out that there's weakness in consumption in the two biggest consuming nations, 20 million in the States, 15 million in China. And if you don't have growth there, then the assumptions that OPEC had that there would be 2 million barrels of growth this year, they may not even be 500,000 or 600,000. And if that's the case, inventories are going to build. And once we get through the summer driving season, so September, October into November, and if we start seeing builds, today we saw a draw, but a lot of it was related to a pickup in exports. But if we do see build-ups, starting in September after Labor Day travel holiday is over, that I think is going to bring the price down. And if the stocks correct another 5 or 10%, we're going to get some tremendous buys, and we'll be sending out buy lists. One thing we are doing is we're going over all the quarterly reports that have come out, and we're having our quarterly webinar, another reason for people to consider subscribing. And we're going to have that quarterly webinar next Thursday. And it's a 90-minute session on the 29th of August, Thursday from 7 to 8:30, and we do 2 Q&A sessions along the way, plus my presentation. So we have a lot going on now, and so the report that you'll see this Thursday is going to include 23 companies, the biggest report I've ever done, just over, reviewing their Q2s. So that would be in the hands of subscribers before the webinar next Thursday.
I appreciate you mentioning that call, Joseph. And yeah, that's a lot of companies, 23 companies to go over, diving into the Q2 financials. Good opportunity for people to get on the stick here, get a subscription, and check out that call. You brought up the fact that you're looking for this buying opportunity as oil prices continue to pull back and the demand side is weaker. But you mentioned the only draw we saw was because of exports. Well, speaking of exports, that makes us think of natural gas, and we're getting close to these LNG terminals coming on where there's going to be more export capacity in both Canada and the U.S. How are you looking at natural gas pricing? How are you looking at the market for natural gas? People are always wondering, Joseph, are we going to see $3 again? Are we going to see $4 again? Or are we going to be stuck in the twos?
Well, U.S. is $2.15 U.S., and today AECO, I think, is 70 cents Canadian, which are lousy prices. Nobody makes any money at that rate, but it's mostly a byproduct of the liquids-rich Montney in Canada and of the liquids-rich Permian in the States. So you want to produce the oil, and if you don't get much for the natural gas, you really don't care. But once the 2 more LNG plants come on in the States and 1 in Canada, LNG Canada, phase 1, train 1, that's going to help. We know that we have Cedars approved with the Haisla Nation, and Pembina's working with them, and it's majority owned by the Haisla Nation, I think 50.1% and 49.9% for Pembina. That project is moving forward 2028. We have 2 or 3 other projects that are moving forward, Rockies LNG being one of them, one backed by Enbridge, which of course has the financial power to do it. So we're going to be seeing 6 to 7 BCF by the end of the decade. We're producing about 17 BCF. So just LNG Canada is 2.1. So 2.1 on 17, that's 11, 12% additional volumes that are going to go to the west that aren't going to go to the east and the south, and that'll tighten things up in Canada. And that's why you can sell gas for all of 2025 at over $3 Canadian, because everybody assumes everything's going to tighten up. And you're seeing companies hedge to make sure that they're okay, given the current pricing, which is pretty horrible.
Joseph, is there a risk here that when these terminals come online and that demand side picks up, even though we still have production, fairly solid production at these lower price levels, that, let's say, price moves up $1, that supply could drastically increase as well, and maybe the upward pricing moves in natural gas while they're there could be a bit muted?
Well, the question is, a dry gas is not really an attractive. There's a lot of shut-in dry gas. So if you get to $3, you'll probably see that come on. But the key thing is where is it going to go, the takeaway? So if it's dry gas in northeast BC or right on the Alberta-BC border, then it can go west into the pipelines. If it's stuck in lower central Alberta or Saskatchewan, then I'm not sure you're going to see it come on stream until prices become very attractive and you can sell it not just for a blip during the wintertime, because you don't want to spend a lot of money developing and putting in the infrastructure, compression, all those things, if you don't see a sustainable price for some length of time to justify the capital expenditures. So a glut coming, I don't see in the near term. If we get very high prices and the LNG terminals are desperate for gas and they buy it and tighten the inventory situation in Canada and in the States for the U.S. Designations and for the LNG plants there, they're going to double the LNG capacity in the States, between now and the end of the decade. And I think, 7, 8 years ago, they had no industry. So they've come from nothing in 7 or 8 years to be the largest LNG producer in the world. And it's needed because the growth rate in China, South Korea, India, all these countries are going to want to switch from coal-fired. Nuclear is not really getting that much support. As I saw, China was going to add 2 more nuclear plants but they're slowing down building coal-fired. India's planning to slow down coal-fired, and the interim fuel that everybody wants to go to is natural gas because it's less environmentally a problem.
Well, Joseph, when you're looking at the companies that are exposed to natural gas, either as a forward producer or maybe as a contributing co-credit, how important is the difference between the dry gas but also the natural gas liquids? We don't spend as much time talking about producers that have natural gas liquids, but a lot of times they have more of that than the dry gas if they're an oil producer. How do you balance that out when you're evaluating these companies?
Well, you want companies that are producing 20 to 30% liquids because that's over half your revenues then. And those companies, even with, $72 or less WTI, they're still doing well. But to really see both engines moving, you're going to need to see 250 plus Canadian AECO. You're going to need to see, oil prices north of 80. And then the industry is going to have to make the decision. Do we, produce the same volumes unless we can contract more to the LNG plants? And do we, pay down debt if that's still an issue? And then how much do we do for shareholder returns? And companies have been arm twisted by the street for shareholder returns, both NCIBs and, special dividends and dividends. So we're going to probably see the shareholder return argument staying in place, which means companies can't be stupid and overinvest and bring on too much production because shareholders are on top of them now saying, we need a return along the way. You're not here for growth. You're here to make money for us.
All right, Joseph, let's move into the energy stocks then. I want to talk from a high level, starting simply looking at XLE, that ETF that follows the energy sector and shares. That's down about 10% from the April high. Oil is down about 16%. Natural gas is actually up a bit from April, but well off of some of those spike highs we saw in May and early June. It seems interesting to me that the energy stocks almost seem to be holding up better than oil, but again, they're balanced with natural gas, even in this more flat, almost boring environment. Broadly, how are you looking at these stocks? I know you're waiting for buy signals, but the stocks do seem to be holding up fairly well.
Yeah, I think, as you mentioned, the XLE was at 98.97 at the high. The low for the 52-week low was 78.9. It's 88.58 today. I think it could go down to the low 80s if we see a break of $70 WTI. I think that seems to be a magic number that really has a downside pressure on the oil stocks historically, because the margins get cut severely. You take $10 off the price of oil, and and your break-even cost, let's say, is all in the 50s. Well, if you're getting 80s plus the exchange rate, that's a big number. On the other hand, if the price comes down and the exchange rate is not so generous, then, I think we're going to be seeing the TXX today, energy index is 284, and the high was 308. I think it could go below 240 over the next month, and that would be the thing that drives some very, very attractive buy levels. And one thing I've talked with you before, which is the energy bullish percentage index, and historically when the market's very buoyant, it trades in the 80-90% range. And when you were talking about April, when we had the high for the year, it was trading at 91%. So 91% of investors were bullish on the price of oil. If you go back to early August when we had that pullback, we were down to 23%, and the number from last night's close was 31.8. I think we're going to go down below 10%, and we have had 10% below before. If you go to March of 2020, we were down at 3.7%. If you go to March of 2023, we were down at 8.7%. September 2022, we were 4.8%. So anytime you get down below 10%, it's a buy. Anytime you get below 5%, it's a table-pounding buy. And given where we are now and the price of oil going down, and if it gets below 70, I think we're going to see at least a buy signal. But we may, if we get below 5%, have a table-pounding buy signal, which is it's an infrequent signal, but it usually is a very, very reliable signal. And the upsides usually from there can be multiples, when you get the rally phase thereafter.
Well, we'll be looking for that table pounding buy signal for sure, Joseph. But when you look at the range of companies in the oil space, the smaller producers and some of the developers, they got hit a lot harder. So when you look at XLE, they've held up better, the bigger producers. But when you look at XOP, it's a little bit different story. I mean, the April high was 162 and it just dove down to 127. So a lot bigger percentage move down, a lot more volatility in the smaller to mid cap companies. Do you think that there could be bigger returns to the upside if people positioned in some of the admittedly riskier but higher torque small and mid cap companies?
Yeah, if the smaller companies have a good mix of oil, like, let's say 40 to 60%, which means that bulk of their revenues are coming from the oil side, but have some natural gas, so you have the torque when that kicks in, and have good balance sheets, and debt to cash flow is under 1 times debt to cash flow, and are trading under 2 times cash flow, that usually is a bargain territory. And I see some names that are there now. And if I'm right about the pullback, we're going to get even more names. And that's why I think we have a good list of action on our buy list right now. I think I'm going to probably add 6 to 8 more names to our buy list sometime in the next few weeks if we do get that buy signal. And if we get the table pounding buy signal, I think almost, the majority of names that I cover will end up being on the buy list.
The fact of the matter, too, Joseph, is that these companies, the oil companies especially, are still pumping out pretty good earnings. We've had a lot of earnings releases in the last few weeks. Anything stand out to you in terms of the overall sustainability of these companies and maybe why some of those majors are holding up better if they are generating decent profits? Give us an earnings recap, please.
Yeah, well, the larger cap companies, number one, are a lot of the oil sands producers. So they have stable production or slight growth because of SAGD and, tweaking the capability of the facilities. And of course, prices have been pretty high. So you've had them be the darlings of the street. But historically, they're high beta. So if the price of oil goes down below 70, I think those stocks are the ones that are the most vulnerable. And the smaller ones that have already been beaten up and are down significantly from their highs, they're the ones that probably will not see much more downside, but they're all going to be able to be, and they're going to be small and medium-sized companies where you're going to want to be a buyer. And in the meantime, many of these companies have very strong balance sheets and have, significant, dividend paying capability. I'll just give you, a couple examples of some of the dividends that are out there that I believe are secure. And so investors should be doing their homework on which names fit their appetite based on the size of their investment and the focus of their investment portfolios. Are they large cap dividend yielders? Are they conservative or whatever? But I can give you a few examples. Whitecap has a 7% dividend yield right now. Companies like Paramount, 6.3% dividend yields. If you like royalty trusts, Freehold Royalty pays $1.08, 9 cents a month, 7.9% yield. Pinecliff, 6.4% dividend yield. You've got Surgenery, which is 7.6% dividend yield. Hemisphere, 5.7% dividend yield. Petrus Resources, 8.9%. InPlay, 8.2%. So these companies are going to be able to continue to pay those dividends. And if we are right that we're going to see $90 oil during winter 2024-25, and if I'm right that we go into $100 oil after 2026 thereafter and higher on the price of oil because of the demand growth, that we're going to see as China recovers, U.S. starts coming back, and all of the countries where new capacity is going to come on with all of the products that are going to be needed for the climate change, renewable world, nickel, copper, lithium, all those things that are going to come from South America, Asia, Africa. They're going to need a lot of fossil fuels to build out the mines. The people who work there are going to want a higher quality of life, electricity, cars, all the rest of it, better standard of living in their food. All of that is going to cause an increase in the demand for energy. And I'm in the camp that, we got up to 147 in summer of 2008. I believe before the end of the decade, we will see all-time highs for the price of crude oil. And, you look at some of the commodities, we've seen some of the food ones like cocoa and others go to all-time highs. And of course, we've seen gold go to all-time highs. So, the commodity board is waking up, and it's just a little bit now. The grains are still sloppy, but I think we're going to see the whole commodity board go up because the inputs, farmers are going to need more for the grain if fuel prices go up and tractor prices go up. Ranchers are going to need more, for the cost of, because as they raise cattle, input costs of grain will go up, and all the things they need to produce will go up. Manpower, labor, etc. So I think that we're into a commodity cycle that's still in its very early stages, and we've seen a few breakout that kind of are giving us the feeling. Even copper had a run to $5. It's backed off because of China's slowdown, but it broke out to a new all-time high at $5 and backed off to $4. So I think that people should be looking. I'm the energy bull and long term, and we'll talk names. And there's some great ideas out there, but investors that are listening should also be looking at those critical minerals and companies that are going to be able to bring them on, be it lithium, copper, nickel, uranium. All of those are going to be needed into the end of the decade, and there's shortages in all of them now. And so as we see the incremental demand come in, it's going to mean prices are going to elevate. So I think we're looking at the beginning of a commodity cycle, and so people should have exposure to all the areas of it. And my view is that if we want to get to a more environmentally friendly, situation at the end of the decade, we're going to need to bring on a lot more copper, nickel, all those inputs. And of course, we're going to need a lot more energy, both oil and natural gas. I'm not in the camp that says that by 2035 we're going to be seeing peak oil. I don't believe that, because you look at the populations of India, China, South America, Africa. The OECD may see declines in demand because of the maturity there, emissions controls, more EVs. But just think about the amount of new capacity we need for electricity in the OECD, North America, Canada, because if we want to be able to have data centers, if we want to have more electricity for all the things like cars, the EV cars, we're going to have to spend an enormous trillions of dollars to build out the infrastructure just for the electricity grid. And that alone is going to cause, a lot of these raw materials that we've talked about to have big bounces as we go in the years ahead. So investors should look to the experts there. You guys are interviewing people all the time who have projects that are and financial capability on those areas. But I from my side, I would say and the biggest commodity market value is energy. Have a decent amount to energy, but also have a decent amount to the other areas.
Yeah, great points, Joseph. And I think the other areas, the critical minerals, still play into the energy theme, whether it's lithium or copper or uranium. They're still part of the energy complex along with oil and nat gas. So great comments there. I just wanted to ask you real quickly about two M&A deals we saw in the sector worth noting. Tourmaline Oil is acquiring Crew Energy, and Gran Tierra Energy is taking over i3 Energy. What do you think about the pickup of M&A in the energy space?
Well, in terms of Tourmaline, I think really believes in the LNG export potential on the west coast of Canada. Plus, of course, there's going to be a lot more in the U.S. So they have already shipping gas to the LNG in the U.S. They are part of Rockies LNG. They're going to be shipping potentially to LNG Canada is going to make a decision this year for the Phase 2, Train 2. So there's a lot of upside, from this. And I think that deal for Crew gives them a lot more reserves on the BC side. So now they were the biggest natural gas producer in Canada. Now they are the biggest Montney natural gas producer. And from the shareholders' point of view of Crew, you end up in what's considered the best management company in the energy space in Canada. Mike Rose and his team did Berkeley, Duvernay. Now you've got Tourmaline, and you get a dividend. You're going to have a base dividend of $1.40, no dividend in Crew. And then you're also going to get special dividends, which they've paid regularly from excess cash flow. So I think that when you take it all into account, you're looking at a name you want to be involved in. And if you have Crew, if you bought it at $3, $4 or less, roll it in, and the dividend on that yield on your cost is going to be very generous. And the i3 deal, it's a counter-cyclical decision, by Gary Goudry and his team at Gran Tierra. They were looking to get into MENA, Middle East, North Africa. But this deal was a deal where it got them, natural gas and some oil revenues or production in Western Canada, about 20,000 BOEs a day. So they have, let's say 30,000 BOEs a day in Colombia, oil, 100%. Ecuador, they have, potentially 6,000 BOEs a day because they've drilled new wells, and the best well, I think, came in at over 2,100 barrels a day on the IP, and some of them are producing, almost everyone, I think the ones that are over 30-day are producing over 1,000 barrels a day. And now you add, 20,000 in Canada, of which I think 80% of that was natural gas. I think that's a contra investment approach, and I think it would, expand the investment, interest in Gran Tierra, because they will have a decent Canadian base on top of their South American base, and I think that would bring them a new shareholder group and potentially an expansion in the valuation of the company.
All right, Joseph, always interesting hearing your take on the energy sector. And hey, we're waiting for that pound the table buy opportunity, something that maybe we'll even see next month. We will follow up with you next month. Again, Josef Schachter, founder and editor of the Schachter Energy Report. Be sure to sign up for his report and also click the link in the show notes to learn more about his conference, Joseph's Catch the Energy Conference, again happening October 19th in Calgary. Joseph, thank you very much for your time on this weekend show. Everyone, thanks for tuning in on this weekend show. I hope you all have a great rest of your weekend, and be sure to go back through our website, podcast, and YouTube page to listen to all of our daily editorials. Have a great weekend, everyone.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.